India's response to the potential economic disruptions caused by the new US tariffs is a testament to the country's resilience, strategic foresight, and ability to adapt to the challenges posed by global economic shifts. While the immediate impact of the tariffs could be disruptive, India has already begun laying the groundwork for a more diversified and robust trade strategy that not only seeks to minimize the negative effects of US tariffs, but also aims to create new avenues for growth and stability in global markets. This multifaceted approach will help India to strengthen its position on the world stage, reduce vulnerabilities, and maintain its trajectory of economic growth. One of the most significant steps that India is taking is to reduce its over-reliance on the US as a trading partner. For years, India has depended heavily on the American market for its exports, but the current situation underscores the risks of such dependence. In response to these risks, India has been actively working to diversify its trade relationships, seeking alternative markets where its goods and services can find demand. One key aspect of this strategy is the strengthening of trade ties with countries and regions outside the US. India has already made significant progress in establishing and enhancing trade agreements, particularly with the United Arab Emirates, UAE, and Australia. Through comprehensive trade frameworks like the Comprehensive Economic Partnership Agreements, CEPA. These agreements are designed to increase market access for Indian products, reduce tariffs and streamline trade barriers with countries in the Middle East and Asia Pacific. With these agreements in place, India is strategically positioning itself to gain from a broader, more diversified network of trade relationships, reducing its exposure to any single economy or set of external shocks. In addition to the agreements with countries like the United Arab Emirates and Australia, India is working on negotiations with the European Union and the United Kingdom. These two major Western economies represent significant markets for Indian goods, particularly in sectors such as pharmaceuticals, information technology, IT, and textiles. Successfully concluding trade agreements with the EU and the UK could provide India with expanded access to these markets, offsetting potential losses from the US market. These partnerships not only broaden the scope for Indian exports, but also provide India with a stronger negotiating position globally, making it less vulnerable to sudden shifts in any one market. Simultaneously, India is continuing to focus on its Look East policy, which prioritizes strengthening trade and diplomatic ties with Southeast Asia and East Asia. This policy is central to India's broader vision of becoming a more integrated and influential player in the Indo-Pacific region. Southeast Asia, which is home to rapidly growing economies, offers a wealth of opportunities for Indian exports. Countries such as Japan, South Korea, and members of the ASEAN bloc are all key partners in India's diversification strategy. India's growing economic integration with these countries, through both bilateral and multilateral channels, opens up new avenues for trade and investment, especially in sectors where India has a competitive advantage, such as pharmaceuticals, IT services, and manufacturing. While India had previously opted out of the Regional Comprehensive Economic Partnership, RCEP, in 2019 due to concerns over market access and trade imbalances, the rising tariff pressures from the US could prompt India to revisit its decision. Joining the RCEP could provide India with greater access to the growing Asian markets, helping to reduce its reliance on the US and increase its competitiveness in the region. India is also placing significant emphasis on emerging markets outside of Asia, including Africa and Latin America. These regions have demonstrated increasing demand for Indian products, particularly in areas like pharmaceuticals, automobiles, and IT services. India has long been a major supplier of affordable medicines to Africa, and as the African continent continues to develop, there will be greater demand for a range of goods, including medical supplies, technology, and consumer goods, which India can provide. Similarly, Latin America, with its rapidly growing consumer markets, offers India a promising destination for its exports, particularly in sectors such as agriculture, automotive, and information technology. In addition to diversifying its export destinations, India is working strategically to move up the value chain in terms of the types of goods it exports. Historically, much of India's export success has been built on the back of producing low-cost, mass-market goods such as textiles, basic pharmaceuticals, and IT services. However, India is increasingly focusing on upgrading its production capabilities to manufacture more sophisticated, high-value products that can command better prices and offer higher margins. In the pharmaceutical industry, for example, India is working to shift from producing basic generic medicines to more specialized, high-value drugs such as biosimilars and complex generics. These products are not only in high demand in developed markets like the US, but also represent a growing segment of the global healthcare industry. In the IT sector, India is focusing on emerging technologies like artificial intelligence, AI, machine learning, and quantum computing. These cutting-edge technologies represent the future of the digital economy and offer India the opportunity to become a leader in these high-growth, high-margin industries, which can help offset the impact of the US tariffs. The government's production-linked incentive scheme has been central to this shift in India's economic strategy. The PLI scheme provides financial incentives to companies in key sectors, including electronics, automotive components and medical devices, to encourage higher production levels and greater global competitiveness. By providing targeted support to these sectors, India aims to boost its manufacturing capabilities, attract foreign investment, and move up the value chain in industries that are in high global demand. This effort is designed to create a robust, diversified manufacturing base that can better withstand external shocks like tariff hikes from the US and other trading partners. India's domestic market, with its growing middle class, expanding urban areas, and improving digital infrastructure, also plays a crucial role in cushioning the impact of the tariffs. The country's domestic market is set to become one of the largest consumer markets in the world, with projections suggesting that the middle class will reach approximately 600 million people by 2030. This growing consumer base, along with the increasing levels of disposable income, will help drive economic growth and provide new opportunities for businesses. The government's initiatives, such as the PM Gati Shakti plan, are also aimed at improving infrastructure and logistics across the country. By enhancing transportation networks, reducing logistical bottlenecks and improving supply chains, India will be able to lower production costs and make its manufacturing sector more competitive in both domestic and international markets. Furthermore, India is considering a range of fiscal and monetary policy measures to mitigate the impact of the US tariffs. On the fiscal side, the Indian government may introduce targeted tax relief and subsidies for sectors most affected by the tariffs. This would help ease the burden on businesses in sectors like pharmaceuticals, textiles, and IT services, which are particularly exposed to the effects of the tariff hikes. The government may also introduce measures to boost investment in critical sectors, thereby supporting economic growth despite the external challenges. On the monetary side, the Reserve Bank of India, RBI, could adopt more accommodative policies to stimulate economic activity. If the broader economy experiences a slowdown due to reduced export demand, the RBI may choose to lower interest rates or implement liquidity measures to support businesses and stimulate consumer spending. This would help maintain economic momentum even if the global trade environment becomes more difficult. India is also engaging diplomatically to resolve the trade tensions with the US. While the new tariffs present challenges, India's growing strategic importance in the Indo-Pacific could provide some leverage in negotiations with the US. India has become an increasingly important partner for the US in the region, particularly in the areas of security and counterbalance to China's rising influence. This growing strategic alignment could open the door for discussions aimed at easing trade frictions, particularly in sectors where India has a clear competitive advantage, such as pharmaceuticals and IT services. In conclusion, India's strategic response to the potential economic disruptions caused by US tariffs is multifaceted and forward-thinking. By diversifying its trade relationships, upgrading its exports to higher-value products, strengthening its domestic market, and engaging in targeted fiscal and monetary policies, India is positioning itself for long-term economic resilience. The challenges posed by the US tariffs are significant, but India's ability to adapt to the changing global trade environment will ensure that it remains a strong and competitive player in the global economy. As India continues to pursue a more diversified and robust trade strategy, it is well on its way to securing its place as an economic powerhouse in the years to come.